Hello guys and welcome back. In this video we are taking a look at Crowdstrike or Crowdstrike Holdings as the full name of the company is, ticker symbol CRWD. And the stock was actually up yesterday 3%, but overall take a look at this, $300 was the 1 year high and it's down about 52% from that. And so we're going to be taking a look at what the company has been doing financially and whether it makes any sense to buy right now. Now, the IPO days, back in the IPO days of this company, a recent IPO, the initial price was like 58 bucks and then it climbed very, very high and it had a little bit of a drop a little bit later. And right now it is at 142 bucks. And let's see whether it makes any sense to buy. Before moving on with this, let's examine whether there is any interesting news here in terms of the company. It's mostly talking about stocks that have been a tech wreck for the most part, and they are getting suggested pretty much by all sorts of articles, so nothing really new here. So let's examine the financials and see what the company is doing there. Now the P ratio is negative. This means that the company is losing money, of course, because net income is negative. We never want to see that, but we will examine the details. Price to free cash flow is high, but at least it is positive. It's pretty high though, 74.9, points to a company that is overpriced for its free cash flow. And it's look at this, it was much more overpriced, of course, when the price of the stock was much higher. Now look at these outstanding shares here. They have been getting increased massively. They used to be at 148 million back in 2020, and right now they are sitting at 232, up more than 50%. So the company has been issuing shares like crazy in the years where the stock was actually going higher, and they were getting some financing through that. But if you bought at the IPO times, you are actually massively diluted here, so that's not great. Okay, so revenue growth at 1,000%, absolutely amazing revenue growth here, more than 1,000%. Yet the net income is going down, and the free cash flow, it is going higher. We'll examine why. Total equity growth also increasing because remember the company has been selling stock like crazy, and thus this is increasing its equity but diluting investors, so it's not great. Now, the debt that the company has is not much. For the moment, it looks like they are financing themselves through stockholders. And the returns, however, are all negative, and the margins as well, because the company is not making money yet. So this is not great to see. It's not paying any dividends in terms of the company is not paying any dividends in terms of that. Now, I'm going to take a little bit of a closer look at the financials. Let's see what's going on here. The revenue has been increasing massively from 100 million to 1.4 billion. That's pretty steep increase, so the company is doing very well in terms of revenue here. And the net income from minus 135 to minus 232, this is not getting better yet. And this is a little bit concerning because at some point the company was going down in terms of losing money, as you'll see. And then over here, this is their worst year, basically, in the last 5 years. So that's not great to see. We do want the opposite course, really. And as you'll see here, in terms of the total equity, it has been increasing quite a lot, of course, because additional paid-in capital coming in from stockholders who were willing to buy the stock as the company was issuing more shares. This is what's happening here. Okay, what about the cash flow? What's going on there? Pretty much the typical thing that you see out of the tech companies, especially the Bay Area companies. You will see that they are making no money because this stock-based compensation is actually extracted from the net income, but it's added back to the cash flow statement, and the same thing with the depreciation amortization. And this is what's making this value positive here, with also some non-cash items being added back here. These are one-offs. And some change in the working capital, but overall you will be seeing some pretty hefty amounts of stock-based compensation, which tends to increase substantially. You see it was like 12 million, 20, 79, 149, 310. So the company is paying more and more in stock rather than actually paying salaries, and this is getting added back to the operating cash flow. And in terms of net cash used for investing activities here, you will see that the company is just acquiring some stuff, purchasing some investments, pretty normal things. For the most part, also some capital expenditures. And in terms of financing, they are getting just a little bit of debt over here, as you'll see, and quite a lot, actually, back in 2021. And the cash that they have is about 2 billion, much more than they had at the beginning of the period of 2018. But remember, they have been selling shares like crazy, and this means that You may be making some cash here, but you're actually diluting stockholders, and there is the stock is actually worth less intrinsically. So pick your poison, I suppose. So free cash flow, 88 million loss here, but 441 million gain. Now, if we take a look at the stock evaluation tool, of course, this is going to be a weird story because we're having negative net income here. The company is actually losing money. And so this positive free cash flow is not going to be much encouraging here. So let's see what we can do here. In terms of the revenue growth, we can go high. The company has been going very high. So I will actually go very high here. I will even try 20 and 30 and 40 and see what we can get out of this one. It looks like the company has been growing their revenues very, very fast. And also, they are doing very little revenue yet. And so as they are growing, they have a lot of room for massive revenue growth here. So let's just say that the company achieves either 20, 30, and 40, which is of course exorbitant, but we're going to try that. The problem is net income margins. They are negative every year, so the company is losing money, which means that we have to go borderline profitability. And this is again a very aggressive estimate. We are expecting the company pretty much starting next year to start making this one. And the free cash flow margin that we're going to use, of course, we cannot really consult this table because this relates to negative net income margins as well. And so we have to go with something that's relatively normal. 80, 90, and 100% is what I like to use, and 13% for my annual return. Remember, this means that the free cash flow that's going to be generated is going to be 80% of the net income, pretty much. That's what it means. So if we hit calculate, let's see what we're getting for this one. Yeah, as I would expect, we're way off, substantially off here. And even if we're giving this revenue growth of 20, 30, and 40%, because the net income is actually very, very limited here, we are getting very low values in terms of our max price to pay. Now, if we are willing to say that the company will eventually achieve something like 10% and maybe 14% and 16%, it is only then, in this case, that we're gonna be much better, but still, current price is way elevated, even at this scenario, which is an extremely aggressive scenario here based on what the company has been doing. And so this means that, practically speaking, this current price for Crowdstrike is very, very expensive, and there's just no reason for holding a company at this price, at that expensive evaluation, really. It's very, very expensive. Remember, the price to free cash flow was 74 even. So if you take a look at the free cash flow that the company was generating, we can take a little bit of a quick look, cash flow statement. Remember that they were generating 441 million, and you also need to remember that this is an adjustment because they were not profitable. But let's just say that they are generating, 441 million, and they are profitable. If we take a look at the stock analysis chart, you will see that the company's market cap is 33 billion pretty much, and this is what makes a 74 over here. If you do the division, very, very expensive. I mean, the company's valuation is very high compared to what they are doing financially, and they could be doing better in the future, but it is only then that I would potentially be justified to pay this price, because right now this is very expensive and I need to get off of this one. So thank you for watching the video. I hope you enjoyed. Just wanted to make a video about Crowdstrike. It has been asked by people before. It was a request, and time to make this one. Let me know what you think about this company, and please remember to leave a like and subscribe. You can always become a patron and get access to this tool, in which you can try your own stocks and your own valuations. And you can find links in the description box below this video if you want to do that. Thanks for watching this video, and I'll see you in the very next one. Bye bye.